Yeah, Joe, I was just going to mention that back when I was a landlord and I had 8 units, this was the time of year that I used to try to take advantage of the situation and put myself in a good position with each tenant. And
Sure.
like I mentioned that when I was the landlord, of course we had a lease and it was legal contract that you had to abide by. But I'm still a handshake guy, and if you called me and said I can't get the rent to you for another 2 weeks, I was okay with that. Thanks for calling me. And this is the time of year though where I would, with each tenant, I would go to their door, and if they're home, great, and if they're not, I would just slip it inside the door. I'd give them a little poinsettia, maybe a $10 poinsettia for the holiday.
Sure.
And I was always amazed how happy they were to receive something from their landlord. The landlord, the bad guy, and it just created a better working relationship going forward. Whether they were tenants of 2 years or 2 months, I just wanted to at least spread the good cheer, spread the goodwill, and if we ever had some sort of an argument or anything, I would always get the benefit of the doubt because of just stuff like that. So it's not a big investment money-wise. It doesn't take a whole lot of time, especially if you're just got a few units. But just doing that little bit at this time of year goes a long way. Anything from, hey, we want to cut the lease short, or hey, this is coming up, and just stuff like that. I always found myself being the beneficiary of good tenants more and more if I did something like that.
That's an incredible piece of advice, and I'm so glad you brought that up. I mean, paying it forward to receive goodwill on the backside in return. I mean, that's something that's a great takeaway for the podcast listeners. Thanks for bringing that up, and I'll definitely make sure that that's a great piece of advice for myself included. I've actually thought about that. I've never. I don't know if I should put this live, but I've never actually done that. But I've heard of landlords delivering, frozen turkeys or some type of something, or a gift card. I think I had a conversation with somebody not related to the podcast how they would just give out a $25 gift card to like Target or Walmart, and how ecstatic the tenants would be and how it did improve the relationship. So awesome piece of advice. Thank you for bringing that up.
You're welcome.
Welcome to the Investor Empowerment Series radio show, empowering your real estate investing with techniques, opportunities, and information, minus the BS and sales pitches. Now, please welcome the host of the Investor Empowerment Series, Joe Mueller, from the Tough as Nails Investment Syndicate. Joe Mueller.
Hey investors, I wanted to give a quick insider opportunity to the listeners out there who are currently doing deals or just getting started and looking to create more financial efficiencies for their real estate business. Introducing Investors Title Services, a much lower cost option for procuring the necessary title insurance policies for your real estate transactions. Think about how much money you've spent on title insurance in the past on either your current purchases or sales, and think about how much you'd be savings if just a couple $100s per transaction ended up back in your pocket. Well, now you can by optimizing the relationships that other investors have established that you currently need for your business. That's what we do here at Investors Title Services. If you're a fix and flipper, a wholesaler, or a buy and hold landlord, we specifically serve this small niche, offering you the best deal on title policy insurance. Call 847-443-9676 today to learn more about how you can save hundreds of dollars, if not more, on your next title insurance policy. It does. It happens to be cash. Yes.
That's
so
fantastic.
Cash is cool. I still deposit it though and put that into all my
I'm
QuickBooks
not the IRS.
records.
You have to tell me.
I know that's funny, but I'm like, I don't know what it is in my head. I could easily just keep it as cash, right? And you're right. We're not no IRS agents listening to the podcast, but for some reason I like to see that it goes into the bottom line monthly, and then I can produce a report, for 12 months and go, oh yeah, I got rent every month on that property, and I have an accurate number, just the way my brain
comes
works.
in handy if you ever get the call from the IRS. I got audited years ago.
Oh God, I don't even know if I want to know about that. That scares me.
No, it worked out, but I was like you. I was like, man, I'm not going to take $20 out of this cash.
Right.
I deposited everything. And I was like, okay, I'm ready.
Well, even as a lender, though, right? Like, doesn't that matter on your end if you're like, let's say you're just refining one property and the guy, puts half the cash in his pocket and then has no record of it?
It happens often. Now, if somebody has a really good income and I don't need to have so much cash flow out of that rental property, that's fine. But if that somebody needs this, hey, look, I make the guy gives me $2,000 a month. Well, your Schedule E says $12,000 for the year.
Right.
So we're not going to tell you we're not going to give you income for what you said. We're going to give you income for what you told the IRS.
Yes.
And
right.
So that's the flip side of it.
So that's a lesson to the listeners as and I am recording, so we're doing a little backwards, but that's okay. I don't mind starting with a little conversation and banter. But
sure,
that's a lesson for the listeners who are maybe not as experienced with a refinance. If you've got a rental property out there and you want to go to a lender, it's best to have all your records accurate and deposit your monies correctly if you actually want to be able to get that loan approved and that refinance to push through. That'd probably be a good way to say it. Okay. All right. So why don't we, since we're about a minute in or so, 2 minutes in, I'm gonna get started and we're all good to go.
Okay.
All right. Welcome back to the Investor Empowerment Series radio show. This is episode number 72 with our special guest, Bill Spallone. That's how you say it, right, Bill?
You got it exactly right.
Awesome. Bill is a 26-year veteran of the lending industry, originally starting at a savings and loan and working his way up through different types of institutions and lending businesses. I assume in the Chicagoland area generally. Is that right, Bill?
Yeah, exactly. I started originally down in the Loop and then out into north side, then Skokie, and then I've pretty much been in that area and also some of the western suburbs for all that time.
Awesome. So Bill specializes in working with first-time home buyers as well as investors. He offers some cash-out refi options and has the reason why Bill's on the show today is because he's got a unique, or I shouldn't say unique. He's got some market opinions of what's going on currently in today's market, as well as maybe what we can see in the future. So that said, we'll let you get started here, Bill. What else do you want to tell us about your background that you think would be beneficial to the listener?
Well, you mentioned 26 years in the business, and
Yep.
that 26 years, I've had a front row seat to quite a few different things. I mean, when I started, I was just beginning, and rates were close to 8%, and I worked for S&L. That, if you remember what the option arm loans were, that's
Sure.
what I was originating, and that's what I was out selling, so to speak. And then of course, you go through the 90s, and it started to get pretty hot market, and then it got really hot at the beginning of the 2000s, and that's when you started to see a lot more different types of lending and different types of investing, and of course, then the no money down. So I saw the business go from, hey, you got to put 20% down, or if you're going to put 10% down, you better have good credit, and then it, from there it just morphed into, well, all right, 5% down, okay, no money down, well, leave your tax returns at home. So I saw the whole thing, and now we're on the other side of that. And now we're on the other side of that, where it's not difficult to get a loan. If you're a standard, your traditional credit risk is going to get a loan. That's not difficult. But anything out of the box might pose a problem, and that could be anything from the quality of the property, the quality of the credit, or even the consistency of the income.
Sure.
So I've seen a lot of different things over the years, and from an investor's standpoint, I've seen kind of markets come and go too, where I'd mentioned before how, it used to be, at least what I was seeing, was people bought a property for investment and they held it, and they wanted to hold it for a long time and maybe get a few more, and this was their portfolio. And I think those people are still out there. It's just that more and more there's flippers in today's world who want to get, who really, they want to get the property for such and such amount. They think they can fix it up for such and such amount in such amount of time and make a profit and on to the next one.
Right.
So that's kind of what I've seen. And just a little story, when I was much younger and I was just new in the business, and I put a coat and tie on and I went to work, and I'd see this guy come in for a refinance or a purchase of a 4-unit property, and he'd sit on the other side of my desk down on LaSalle Street, and he'd be sitting there in a flannel. He'd have work boots on, jeans that were kind of dirty, and he'd show me these tax returns with 4, 5, or 6 properties that really were pretty solid.
Right.
And I looked at him like, wow, I want to do that. I'd like to be 45 or 50 years old with a portfolio, and my boss would be my tenant, so to speak, and just manage all that kind of stuff. So that's what I used to see all the time. I don't see it as much now. I don't know if it's because of the crash or what, but that's what I originally saw in the market. And I thought, this is Chicago's a great market for it. I mean,
Sure.
especially the certain markets or certain neighborhoods, you're not getting declining rents. People aren't moving out of the neighborhoods.
Right.
And I think Chicago is unique in that regard because there's still some pretty affordable areas.
Absolutely. No, that's a great point. There's a lot. There's a lot of diversity and variety in the different types of properties, asset classes, and then the pricing of those properties in Chicago. So it's a great hub for investors to get involved in. I completely agree. Depending on what they're looking to do. I mean, obviously, different pockets of the city are going to create a higher cost for an investor, which may not make sense. But I had a guest on the podcast recently that was talking about how people that already are perhaps well established and more wealthy, or maybe in their retirement years, sometimes just want to park their money somewhere in real estate as opposed to some type of a fund, like a mutual fund or whatever. And that might be more applicable to certain areas in Chicago where they got higher cost for a property and higher rents thereof, things like that. So that's good. So you touched on one thing in the beginning of what you were talking about, and that was you called something an S&L. And that's a savings and loan, correct?
Yes, it is.
So can we talk a little bit about the difference between, what you'd see going to, and hopefully on current times, stopping in at your local, small community bank branch versus a company like you work for, like Prime Lending, that's more of a broker. Is that right?
Yeah, exactly. We're actually a bank based out of Dallas, Texas.
Oh, okay.
$15 billion in fundings. So I'm a mortgage banker, so to speak, but I offer different loans too. I mean, I have various banks, investors to work with, and a good example of that would be I can go with a Fannie Mae loan or a Freddie Mac loan, depending on the situation. And that might not mean much, but the guidelines are slightly different. And I want to tailor that to the particular borrower. A good example would be somebody that's self-employed. Typically, I'm going to look at 2 years of tax returns on a Fannie side. And if he earned $100,000 2 years ago and then $200,000 last year, sometimes the lender is going to say, hey, listen, that's too much of an increase. We're not going to average that. We're just going to give you $100,000 of income. Whereas on the Freddie side, they would, with good credit and a strong file, I could just use the most recent years of income. So that's a higher income and allows them to qualify for more. So I just want to elaborate that, my position is great because I do have many different tools, and that's just an example of it right there.
Right. Sure. No, that's cool. I didn't even know that. That's a good tidbit of advice for people that are looking to do a refinance or even a purchase, right?
Yeah. Again, it just depends on, not everybody's vanilla. Some of them are, and that's great. But sometimes there's a little quirky things. And just to elaborate further on what you meant about the local banks versus a broker or a correspondent lender, I did start with an S&L, savings and loan, years ago. And again, I was really raw to the business. And, it took me a while to realize that, the savings and loan, so to speak, they have deposits. They got to lend the money. And historically, no one has to tell them whether they're making a good loan or not. They know. I mean, they're not going to make a bad loan, and because they're going to lose the money. But then when you get, the mortgages being purchased and sold on the secondary market, well, that changes things a little bit. And that's, let's get to today. And the banks, I'd worked for a couple of banks. I was in bank branches. And, the difference between working there and working where I am now, it's a big difference. Now, a bank is local. People like to, walk in, shake hands, and talk to the loan officer, and that's great. But you're not going to have a lot of different loans to work with. They're typically going to have a niche. Maybe it's a jumbo arm or something else. But, I never felt comfortable when somebody just signed a sales contract in a pretty emotional transaction, maybe the most emotional transaction of their life. And I'm going to say, hey, how'd you like to open up a checking account? They're about to write an earnest money check for $20,000, and I'm going to start to sell stuff to them. I thought that just isn't in my wheelhouse. I just want to originate loans. I want to help people get in their home, make it an easy process, and of course make it a cheap one for them too. So that's by and large what I think would be the best way to describe the difference between working with a local bank branch and working with a broker.
Awesome. No, that's great information. Thank you. You also mentioned earlier that you had this guy come in who was wearing work boots and dirty jeans and a flannel sitting across from you at the desk. I mean, that sounds like something I've done before. I got to be honest. Have you taken a step into any type of real estate investing for yourself?
Yeah, I did. I was fortunate when I was much younger, I worked with a bunch of guys, and it's like, hey, you just got to buy. You just got to buy.
Right.
Very little thought went into purchasing, and it was great timing. When you purchase in the mid '90s and late '90s, and it worked out really well. Of course, then a crash came, and you got to be careful. Everybody's got to be careful when there's a correction. Now, it was a big one, and it had to do with forces outside of things that we can control, of course. But it leads me to something that you had mentioned earlier about what would I offer, what could I tell an investor, and I'd say that there seems to be a fork in the road. I mean, are you going to purchase something for cash flow in a long time horizon, or are you going to purchase something for hopes for a appreciation of value and then sell it maybe in 3, 4, 6, 8 years?
Mm-hmm.
And you can do well in either of them. But when the market crashes, if you don't cash flow, you're really hanging out there.
Sure.
And I didn't have the cash flow that I needed to continue in it. So I got out of it and still able to talk about it. But it's I saw some people just go under, and you saw the foreclosures, and it's, if you don't cash flow, it's a tough one. I mean, if your value goes down 40%, but you're still cash flowing, ride it out. I mean, take a look at now. Take a look at the people that I still talk to, people that bought in 06 and 07, but they held on to it.
Sure.
And it was tough. And now they're doing pretty well. Especially since the rents have gone up so much.
Absolutely. No, that's a great point. As we say in the industry, cash flow is king. So even if you if you do buy a dud, or the market crashes the day after you close, as long as you're making that monthly income, you can still survive. And the best thing to do is to ride it out, which I know is kind of what they also preach on the Wall Street advising as well. When you're getting into retirement planning, stocks, bonds, things like that, you want to be able to suffer some of the fact that there's going to be some ebb and flow to your portfolio. But the key is, especially with real estate, if you can cash flow, you can survive, and that's why it's such a great avenue for building wealth.
No doubt about it. And one thing I miss, I don't have any rentals anymore, but one thing I definitely missed was April. April, when I had rentals, was I always got a real good, healthy check back from the IRS, and it was. No, I meant that in a completely above the table legal way.
Sure,
I mean,
sure.
I have depreciate these properties. I have expenses. If I decided to put some money into a particular unit for whatever reason, kitchen or just repairs, every time I groaned about the cost of it, it showed up. Part of it showed up in April,
right.
And that was a nice little write-off. And I have to keep telling myself, and I'll tell anybody else, hang on to your last rental if you can, or before you sell it, discuss it with your CPA what the ramifications are, especially from a capital gains standpoint.
Absolutely.
So I always remember how fun April was.
No, that's awesome. Yeah, and one of the things we talk about a lot in the podcast is I mean, you brought up a CPA. We talk a lot about building your team, before maybe you even start buying properties, or whether you've already owned some assets and you're expanding, whatever it is, whatever point in your real estate career you're in, always having that right team and having the right people in place to support you. And I think that's one of the reasons why we've got you on the podcast is, we need to hear more about what you guys offer for a home buyer or for an investor out there, to see if maybe there's a fit for some of the listeners out there.
Sure. There's one of the things I know I wanted to discuss was the renovation loans that we offer. I mean, there are renovation loans certainly for first-time home buyers and single-family residences, but there's also for multi-units and even for investors of multi-unit buildings. Now, and I want to clarify, at 4 units and under, I'm a residential lender, not a commercial lender.
Okay.
So 4 units and less, owner-occupied or non-owner-occupied. But, it kind of, I'm going to drift into the market for the lending. The lending standards got so tough that there's always a push to make them a little easier, and that's really been eroded. That's eroded the standards recently. Just it's become easier to get to acquire certain properties and fix them up, and that's just because some of the standards have become more relaxed. So it is easier for investors to get in the door. One of the things I've been telling anybody that'll listen is, if you're a 28-year-old, 26-year-old, and you want to get into real estate, you can buy a 3-unit property or 4 unit in the city of Chicago, and I use those numbers because they cash flow better than singles or 2 units, you can put 3.5% down and buy a property. And maybe it's not in Lincoln Park, but maybe it's 2 or 3 miles from there. And maybe, you can cash flow right out the gate. And, you're only 26, and how'd you like to be 41 years old and have a tremendous amount of equity and maybe picked up 2 more along the way? That goes back to the flannel guy I was referring to.
Sure.
It helps. In today's world, a lot of people are waiting to buy, just maybe demographically. But I think the eager people that, they'd like to be 30 years old sitting on a couple of properties, that's totally attainable. And I think this particular market allows for it, not because it's a booming market, but because it's a consistent one. 4%, 5% value growth annually is perfectly fine. It doesn't have to be 10 and 12, but we don't have to be Seattle or San Francisco.
Right.
But at least somebody can say, hey, this is where I want to park my career for the next 10 years, and I'm going to start early, and I've got a lot of energy, and I can hammer and I can turn a screwdriver, and I think that would be it's a real good option for people that want to get in that business, and this is a good market to do it.
Absolutely. Yeah. I think one of the most important things that you're alluding to is that call to action, right? Like you can get busy getting busy all day long and read as many books as you want and take some classes and talk to well-educated guys like you about what opportunities are out there. But none of that really starts. That opportunity doesn't begin until you actually make a move and get out there and do something. And that's what I'm hearing you say. And that's a message I like to portray across to the listeners as well as the people. We host a meetup out of our office here, and we have quite a few investors that roll through every couple of weeks. Every 2 weeks we do a meeting, and there's a lot of people that are doing things, but there's also there's a portion of them that have been coming to the meeting for years sometimes and don't really make a move. So the best advice out there that I think you're hearing or you're telling me and I'm hearing and we can portray back is, make a move because those opportunities are out there. This is a great market to invest in. There's great partnerships available out there with guys like you that can provide the right types of funding at 3.5% down. I mean, that's incredible if you want to buy a 3 or 4 unit property and cash flow right out of the gate. Yeah. I mean, that's awesome.
Yeah, you could. I mean, $325,000 property coming up with $18,000. That's kind of stuff I've seen. And one other thing I wanted to illustrate about the market conditions, and you probably are aware, but recently the Fannie Mae and Freddie Mac loan limits have increased. The loan limit from jumbo to conforming had been the same for 10 years, and that's a reflection of values. In other words, going back 20 years, every year in December, what's the new loan limit? And it would always go up. And it went to 417, I think around 2008 or 2007. Mm-hmm. And then last year, it stayed because of the crash. And then last year it went to 424, 100, which was the first time it went up in quite a while. And then this year, 2018, it's going to 453, 100.
Wow.
That's a 6.8% increase. And that's important. That's important because my impression is that's a reflection of values having gone up, but I got to believe that's also a bit of a forecast on policy there. Like, look, we don't expect a pullback. We probably expect a little bit more growth and so on. So that's something when someone says, what do I think about 2018? I'm like, that's a heck of a barometer right there.
Sure.
In fact, because the loan limits change for 1, 2, 3, and 4 units, I think you can borrow $875,000 on a 4 flat.
Wow.
Still remain conforming and not be jumbo. So I think that's a ton, but that sounds pretty good to me. And again, I can't stress enough how I think it's not a booming market, and it doesn't have to be. But you put together a 5 or 6 or 7 year period where it's just been pretty solid. That's a great time to get involved.
Right. No, absolutely. It sounds like it. So anything else we can elaborate on regarding what you're seeing in today's real estate market, financial markets, and then what you're forecasting potentially seeing for maybe 2018 in addition to that
other
information?
Than what I mentioned, other than what I've just mentioned, something, yes, anecdotally what I'm seeing is typically people right now where they're out at the holiday parties, they're not out buying right now. They're going to, talk to all their contacts and everything, and it's really not much of an action time in December. And then they'll wait until February and start looking in the spring market. But I'm seeing people being a little bit more active now, and I kind of saw it coming because there was a pullback in the market after the summer. Many people were looking to buy a home, maybe move, maybe buy their first home, and they struck out a few times. They didn't get it, and so they hung it up for a while. And rather than wait for a spring market where they're going to see a lot more buyers, I see people kind of getting ahead of it, and contracts coming in the first week of December, and even over Thanksgiving weekend. Maybe the good weather had something to do with it, because it was nice and people were out looking.
Yep.
But it leads me to believe that right now it is a little bit, it is a holiday time, and not a lot of people are out looking, but a lot more than normal. And as far as the interest rate market, I keep thinking that the rates are going to go up, and I hang it on the fact that they probably, everybody always says they have to go up. I suppose they do, but
right.
When the forecast for GDP growth to go from 1.5% and 2% to 3.5% and 4%, that's, I'd like to think I know what's going to happen on that, but it leads me to believe that kind of growth would lead to a higher rate environment. But wage growth isn't there. And, I think it was even reported this morning that, the wages, they're just not expanding. And whether that has to do with the productivity that you get from technology out of the same amount of employees or even fewer employees, I don't know. But so far the rates haven't jumped. And they every time they kind of inch up higher, that we watch that 10-year Treasury yield approach 2.4 and 2.5, and it comes back down to 2.1. And that means it's only good for the buyer. Only good for the person that's going to borrow money. It's still cheap money.
Right. No, absolutely. Yeah. And again, what you brought up was I actually experienced the same type of market, we'll call it lull, and then interest again at the end of the summer. It was amazing. I felt like in maybe some point in September or October, it's like it was a dead zone out there. Like not much was going on. Yeah. Things slowed down. I'm thinking to myself, okay, well, yeah, winter months are coming. People typically start to pull out of the market at that point if they're looking for properties. But then by the end of October and then through November, it's like, boom, the wheels are spinning again, and we have lots of opportunities coming up, and buyers and sellers getting back into the market again. I thought that was pretty impressive, and we've seen that pretty consistent even at this point, being the 13th of December 2017. And I think another message that I often like to preach out there that I think holds true today is no matter what, I mean, yes, there are people that have come back into the market looking to buy, and there's sellers that are still, looking to sell. This is still a great time, especially with these low mortgage rates, to find awesome opportunities out there for buyers, home buyers, real estate investors, to continue to build. I mean, I believe that this time of the year is actually the best time to buy, as people are focusing more on the holiday parties than they are on their bottom line. Yeah. And, there's still properties out there. And the key factor is the people that are trying to sell today are the ones that really have to sell, not the ones that are going to pull it off the market because they don't want to deal with it through the holidays. If it's on the market, they have to sell it. So that means there could be a better opportunity as well, because they're going to start looking at offers that they may not have considered 3, 4, 5 months ago, for example. So. Yeah,
I think you're right, though, when you talk about that pullback for that 60-day period.
Sure.
For somebody that was a late arrival and decided to list it, August 15th and had a couple of offers, but then didn't do anything, and then it went silent, that might have sobered them up a little bit to say, you know what, it's a different market now, and maybe I should be a little bit more open to my price. So
Absolutely.
I think I've seen a couple people, and again, do they want to see the next cycle of tax bills, all that kind of stuff? And
sure.
Like you said, that they have to sell.
Absolutely. No, that's a great point. So that's some great market insight. So that's some good points regarding what's going on currently, what we've seen in the last few months, potentially for 2018. I mean, and again, the general message being there's still a lot of good opportunities out there on the mortgage level as well as on the real estate acquisition level that can be seized for the interested people that are looking to do that and continue to do that.
I still think it's pretty solid.
So at this point, I'd like to ask if possibly there's any type. I know you mentioned something regarding what you'd tell an investor as far as offering any advice. Is there anything you'd like to say? Like if you had an investor walk into your office today, maybe looking to make their first acquisition or their first refinance on the handful of properties they own, what type of advice would you give them to be prepared in order to succeed and get that loan closed? I'm thinking more along the lines of, credibility kits. What are you looking for? What's going to help them now that they can work on, and when they show up at your office door, to make that close as fast as possible without any hiccups?
Well, just the first thing I'll say is the tax returns. Have your tax returns in order. I mean, by the way, if you're talking a first-time buyer, that's different. I won't need to see your tax returns more than likely, because if you're a W-2 employee. But if you're somebody that's let's say you've got 3 investment properties or 4 of them, whatever, and you want to buy another one or you want to refinance one of them, you'd want to have your tax returns in order. And by that I mean have them handy. Today's wonderful environment of technology, typically it's just call my accountant, he'll email them to you, which is great. But I also bring it up because the 2017 returns will be required if you fund after April 15th or thereabouts. So and some people, they don't want to discuss their 2015 income because it was low. All right, then get your 2017s done pretty quickly, because more than likely we'll need 2 years of them. So that's the first thing I'd say. And that's just on a documentation front. But also when it comes to of course, we'd send an appraiser out to the property if it's a refinance. Make sure it's in order. Make sure, it's not an FHA appraisal, I'm assuming. We'll just do a conventional. And I say that because the FHA appraisals are a little bit more scrutinizing. It could be chipping paint or something else that they want you to fix. But on your conventional loan, they're not going to be generally too picky, the appraiser. So, just make sure the property's in order and make sure your tax returns are available and certainly complete. And then from there, just get a clear idea of what you're looking to do. Are you looking to pull cash out? And what are you going to do with that cash? And, will you get a return on it? And of course, you've just, I said earlier about hanging on to your last rental. Well, if you bought a rental 15 years ago that, you'd like to think would be close to paid off, but you refinanced a few times, and now you've got a balance that gives you only 30% equity, and you had a real gain on it, you're not walking away with a whole lot of money to offset that capital gain. So that's something I always want to make sure people are aware that it isn't a cash register, your property. It is a viable way to get funds and a good tax in a good tax advantage way. But just remember the flip side of it is, if you're getting $30,000 to go to Australia, that's probably not the best use of that money. But whereas if you're getting $30,000 out to add a bathroom or two, that's fine, or another unit. So that's the kind of thing I would want to say to an investor that's looking to finance a property.
Sure. Can we dive a little bit more into the actual product that you could offer? I mean, on a let's say a cash out refi. I mean, what type of options are out there? Let's say, and I'll give you a little more specific an example. If I've got let's say I've got a multi-unit that I've owned for 5 years that's worth $300,000. And I've got a loan balance on it of 150. Let's, obviously egregious opportunities here, but if I wanted to do a refi because I want to pull some cash out to buy another property, what would what's your loan to value type rates and things like that?
Well, depending on the property, you can go to 70 or 75%. And I say between 2 and 3 units and Fannie and Freddie, they're slightly different. But cash out, expect up to 70%, and in certain situations, 75%. But I do want to at least elaborate on one other thing about some of these investors.
Sure.
Some are very, very good with their money, and they want to pay this loan off, and they want to put a 15-year fixed rate on that investment property.
Absolutely.
And that's great. They're going to get a good rate, and they're going to pay a lot of principal and everything else. Going back a few years, when we analyzed the income from a rental property, it only had to do with your expenses and your rent. And the expense was the interest that you paid, not the principal. But now the guidelines dictate that we want to see the mortgage statement. We want to see the mortgage statement on that property, because if you have a 15-year fixed rate, it might cut into your cash flow, of course.
Right.
And we're gonna take that into consideration. So I've seen people who have a couple different properties that are 15-year fixed rate loans, but because of that, it cuts into their cash flow, and it makes it tough to do. In fact, without getting specific, I know the Freddie Mac income, how they analyze income for rental properties, just got a little bit tougher and a little bit more cumbersome than Fannie Mae starting in January. So there's just little things that you would think you're doing the right thing by getting a fixed rate, and it's great. If you don't intend to borrow money, then go ahead and do it. But when it comes time to borrow money from the bank and they're looking at those tax returns, they're going to see, wow, you got a higher payment on that mortgage, and we're not going to give you nearly the income that you think you're getting. Mm-hmm. So it's just something to think about. I mean, if you want the 15-year, great, but sometimes if you think you're going to be in and out of the bank borrowing money here and there, it might be good to just go with a 30-year and prepay on it as you like.
Okay, good point. No, that's some good advice. I have another question I'd like to ask about the actual structuring of these longer-term loans. Right now, there's and again, just your opinion, because I feel like you're really well educated in this niche in the market. There's some companies out there now that are offering essentially like no doc type, and these are not banks or brokers. They are different hedge fund based type companies or backed companies.
Sure. They're
doing investment property refinancing, 5, 7, 10 properties, a little bit higher of a rate, maybe in the 6s or 7s. But they're basically saying like, hey, as long as it cash flows, we'll give you the loan, and they're putting everybody into like a 7-year ARM. What's your opinion of maybe the goods and the bads of working with like an ARM in general? I mean, that's something I don't really talk about too much. I'd love to hear maybe just an explanation for the listener as to what an ARM means, and then what maybe the ramifications could be 5, 10 years down the road if they do intend to hold it for long term. Okay.
The adjustable rate mortgage, whether it's 5 years or 7 years or even 10 years, it has its place in the market. It's if you're fixed rate, and I'll just use some basic numbers. If your fixed rate's at 4%, fixed for 30 years, but you can get something for 3.5% that's fixed for 7 years, because you really don't think you're going to keep it that long, that's perfectly fine. And it happens all the time. If you get that 7-year ARM and circumstances change and year number 8 rolls around, your rate, it's not going to be a balloon payment. You're not going to be required to pay it off in full. Very few of those loans exist anymore. But what will happen is your rate will adjust. It'll adjust to market conditions, typically a short-term index. It could be a LIBOR index. It could be a Treasury index, plus a spread. And just to give you an example, a guy I know, he got a 5-year ARM on his home in 2005, and it expired in 2010. So he's just now going to ride the market. Well, in 2010, the Fed funds rate, I think everything was next to zero. Right. So you're getting 0 plus your spread, and his rate went to 2.75 for 1 year.
Okay.
And then it will adjust annually thereafter. And quite a few people did that, and they were able to annually adjust to their new rate, which was 2.875, 2.75 in that range. But when the Fed increased the rate by a quarter, now your LIBOR index or whatever short-term index was on your loan, now that's going to increase by 0.25%. I think today, in fact, the Fed is meeting, and when they're done, I think at 1 o'clock, we expect a 0.25-point increase in the Fed funds rate, and that's going to increase home equity loans and lines of credit, and those are going to go up by 0.25 point because most of them are tied to prime plus or minus. So,
sure.
So the thing to be careful of with the ARMs is, what you're getting into. What happens when it's over, and do you want to see that adjustment down the road? Some people, again, they don't have any intention of being there very long, and so the ARM is a good way to go. Other people really don't know, so they don't want to have that kind of risk in their life, so they just get a 30-year fixed rate.
Right. No, absolutely. That was you were hitting the nail on the head there. That's what I was going for. Okay, cool. Some great information. So, Bill, at this point, can we get? I'd like to, if the listeners are interested in contacting you, what's the best way to reach you? And let's talk about where you're located, things like that. Where you service? I shouldn't say service, but are you limited to Illinois, or can you expand beyond that? I know you said the bank is based in Texas, so maybe there's some opportunity for multi-states throughout the Midwest, whatever. But tell me more about you and the company and what you guys can do for some of the listeners.
Well, I lend in all 50 states, and
Awesome.
I say that because it hurts when someone says, hey, I want to buy this $1 million home, but, and they tell you it's in a different state and you can't do it. I've worked at places like that before, but fortunately I can lend in all 50 states. My office is in Oak Brook at York and 22nd, and I predominantly do most of my work in the city, north side of the city, and even northern suburbs. Just that's because where I live and always have worked. But I'm also now out a little bit in the western suburbs. A great way to get in touch with me is via email, wspallone, SPALLONE, @primelending.com. That's my email, and I'm pretty good about it. So that's what you can expect out of Prime Lending. And again, even though we're Dallas-based, I can lend in all 50 states.
No, that's incredible. That's awesome. Thank you.
And one thing I've noticed in the market is, maybe because I'm going through it now, is people get socked with college tuitions.
Sure.
They're expensive, and yes, you can get a student loan. Yes, you can save your money and be prepared for it, or maybe you have access to that funds in your home, and the combination of low rates and rising values consistently, not much, but a little bit.
Right.
If someone's sitting on a mortgage that they've had for 6 or 7 years, and now they're thinking about getting a $30,000 student loan or cutting into their IRA for $30,000.
Right.
You probably can refinance your home, get that cash. Now you would go back to 30 years as opposed to being at 23 is where you were,
right.
But your monthly payment will be negligibly different, if at all different. So it's just something that I've been able to help a couple people recently, just afford some of those costs that come at a time in their life when they'd rather not pay them.
No, that's awesome. That's awesome. That's awesome. Thank you. All right. So for the listener, if you're interested in contacting Bill, finding out more information about what he can offer you as a home buyer, or maybe for a refinance of an investment property or a purchase of a multi-unit property, you can reach out to him via email at wspallone at primelending.com. That's wspallone at primelending.com. Bill, I really appreciate you taking the time out this morning to spend it with me and our listenership. You're welcome. Very confident you're going to get some phone calls. You're going to get some emails as a result of this. Sorry about that. I hope we can reconnect again in the near future and maybe kind of do another market recap on what you expect to see. Let's see what happens with this Fed rate raise today potentially, and then maybe in a couple months I'll call you back and we'll go from there.
Joe, thanks a lot. I really appreciate you having me.
Yeah, no, anytime. And again, let's keep in touch on this, and we'll get you back on the show because I know the listeners would be eager to hear about anything that's going on in the market. So
you got it.
This is Joe and Bill signing off from the Investor Empowerment Series radio show, episode number 72. Please feel to reach out and contact him via his email we gave out a few seconds earlier. Rate us on iTunes and Stitcher if you have time. Really appreciate it. That really boosts our ratings, and our reviews are very important. Any concerns or questions you'd like to reach out to me on, that would be joe@tanisgroupllc.com, joe@tanisgroupllc.com. You guys all have a good day. Bill, take care, and thank you very much.
Thank you, Joe.
Thanks for listening to another episode of the Investor Empowerment Series radio show. Be sure to tune in next week for another empowering episode. We welcome your feedback, so please rate us on iTunes and Stitcher, and visit us at www.investorempowermentchicago.com or tanisgrouprealty.com.